Welcome everyone to the Apartment Analyzer webinar sponsored by Lee-Chandler. My name is Marcus Baker, an analyst with the investment team. Today I am joined by my colleagues Rebecca Hong and Bray McIntosh. Please enter your questions in the chat box and hold additional questions to the end. At the end we will answer any questions and allow others to verbally ask their questions. Today we will walk through how to use this Apartment Analyzer tool and the insights such a tool can offer. The formulas used in this tool are fairly simple are similar to many free utilities, and you can even make your own spreadsheet using this as an example. Using an analytic tool like this can help us determine if the property is a good deal and where we can make improvements to the property if we acquire it. The financials can even give us indications of why the owners might be wanting to sell it. Rebecca, would you like to present the first page as I fill it in?
Yeah, of course. So the first page is just a quick overview of the property itself. So the first thing you do is on the top left, you put in the asking price where you usually get it from the seller directly. And then you put in basic information like the number of units, which is 264, and the average rent. And then next you look at the condition of the building itself. So either the age, description, and the renovation. And the condition age is tied in directly to the estimated expense ratio. And the level of renovation needed is tied into the renovation expenses. So in the top, you have a guide there just to help you fill out those two. And then you fill in the comps. So you fill in any comparable properties in the area, and you find how much they go per unit and average it up just to compare to the unit that you're estimating right now.
I would like to add that this property has been recently renovated, so we can estimate their renovation costs should be fairly low. And because it was built in 2001, we went with our property age, category of A, which gives us the expense ratio of only 40%.
Yeah, thank you, Marcus. And then you look at whether the rent is under market. So you usually use online resources such as Rent-O-Meter to calculate the market price for the similar type of property. And you analyze whether or not this property is choosing for their rent to be under or over the market price.
Also, for the comparables, you can use similar programs like Zillow or PropStream to find comparable size buildings, similar age, and generally the same quality areas, because those can change the value of the land. Okay, moving on to page 2. Bray, would you like to cover how we look at the financials?
Yep, will do, Marcus. Hello, new entrant. But yes, so the first thing you're going to do when you're looking at the financials is you're going to want to determine your average rent per unit, which is pretty simple. We just take a look at, it's typically a T12 report. We look at the rent they're getting in per month, and you divide that by the number of units. That will give you your average rent, which you can input rather easily, and that can give you gross rents. Then we'll determine other income if they have, for example, vending machines or any other sorts of items. Then you'll list expenses from the T12, which Marcus will do, which we have already done. And once you've listed your expenses, you can look for important to note, you should look for any abnormal changes in the financial statements. It might tell you if they're having high loan issues or any of the problems. Once you've done all of this, you'll find your NOI, net operating income, as you can see in the yellow box that Marcus is highlighting. And that's pretty much everything we do on that page. Then for page 3, we do our final analysis. You determine loan terms. In this case, we'll put in a standard 20% down, 3% interest, and amortization over 30 years. That will fill in all this information. You'll note the cash flow. We have pro forma information. In the bottom left, there's IRR, which is internal rate of return, which is the IRR is calculating it and assuming that we would refinance over after a certain number of years. That's how that works in this tool. And then also you can see cash on cash return and DSCR, which is debt service coverage ratio, which tells us essentially how much debt that the income estimated can cover. Is there anything else to add, Marcus?
Yes, on the cash out percent here on the right, that is telling us that if we refinance this property after stabilizing it at the pro forma value that we think we can get, when we'll refinance here and we will get half the cash out of it that we invested in the deal. So that means that we can use that money then to then go on and start another project somewhere else. You do not have to refinance, but it is there if you've got another project that you're looking for.
Absolutely, Marcus.
I would like to add for the asking price here, we used $18 million. That was just the asking price that we would have to get a 9% cap rate. Now, for this property, they didn't actually give us an asking price, so we don't know what they would want. By just switching out this number a couple times, though, we can put it at any. We can look at it at different cap rates, see how like a higher price here would hurt us. So let's try 22 million.
There, yeah. Yeah,
as you can see, this still gives us, is still a yes for the deal, but our income from it is considerably lower. Now, on page 2, the financials have all stayed the same. The only difference is our asking price is different. We can see here, DSCR is about, what, 0.4 lower, I believe?
Yes.
Like, considerably lower return on the investment. And at this point, if we tried to refinance after we achieved the pro forma value, you would actually lose quite a bit of money. So definitely not advisable. This property is still bringing in money, and it's still not a terrible deal. Just not quite as good as if we can talk them down a bit on the asking price. I believe that's everything. So let's move on to the QA session. Has anybody got any questions? Okay. Well, we can ask some of our own.
Yeah, sorry. I was just wondering if nobody has any questions. I was just thinking we can explain some of the terms that we use in our apartment analyzer just for people who aren't as familiar with real estate jargon. So I was wondering if either of you guys would like to go over what the cap rate is and how to calculate it.
Sure, I will take care to explain that, Rebecca. So the cap rate or capitalization rate indicates the rate of return that is expected to be generated on a real estate property. This is measured based on net income, which the property is expected to generate, and is calculated by dividing net operating income by the property's asset value and is expressed as a percentage. It's essentially used to estimate what your potential return on an investment would be.
Yeah, thank you. And can you explain what IRR is?
Yeah, so IRR is internal rate of return, which is essentially a financial metric that estimates the profitability of an investment. Basically, the IRR is it's called a discount rate. It takes the net present value of all cash flows and discounts them. So essentially, what you're doing is you're calculating what your return will be by taking the present value of all the money that you will spend or make on investment.
Thanks, Bray. And what about cash on cash?
So cash on cash return is a rate of return in real estate that essentially calculates the cash income earned on the cash invested. So put simply, cash on cash returns is a measure of the annual return the investor makes on a property in relation to the amount of mortgage paid during the same period.
Yeah, thank you. And finally, can you explain what DSCR is?
Sure. So DSCR is debt to service coverage ratio. And essentially what it does is measure a firm, a company, or in this case, a person investing in this real estate. And it calculates their ability to pay current debt obligations with your cash flow. So DSCR, it basically shows you, an investor, whether you have enough income to pay your debts. So if your DSCR is 2, then you're basically making 2 times more income than you are paying in debt. That's basically what it's telling you.
Thank you so much for that, Bray. Yeah, and we hope that his analysis on these terms will help you understand this apartment analyzer more.
As I would like to point out as well, for your debt service coverage ratio, you may note that we've got it set where we want over a 1.25. That is because a lot of banks will not finance you if your debt service coverage ratio is below that. So if we say wanted something, or if we were to pay something closer to like 27 million for this property, we can see the deal analyzer already isn't happy with it. Wow. Okay, I'm surprised. We can actually still get financing for it, though, as you can see from the cash-on-cash return, not a great deal at the moment. But you're getting close there where it will, your income's not going to be high enough to pay the debt properly, and the bank's not going to be happy.
Mm-hmm.
Was there any other questions? Okay then. Let's see. We'd like to thank everybody for joining us today, and we hope that you'll be able to learn more about how to analyze a property and what kind of key terms we're looking for. As always, if you have any questions, feel free to email us at investments@lee-chandlerenterprises.com. And thank you.
Thank you so much.
Thank you.
One last thing I would like to say, if you can think of any other metrics that you think might be useful for real estate or that you would like to know, please let us know, and we will try to add these to the tool as well.